Welcome to the FML podcast, the podcast on a mission to uncover actionable insights, explore the latest trends, and to catalyze your fintech's growth. Join Growth Gorilla's founder and managing director, Sachdev, and some of fintech's hardest hitting marketers and leaders.
Welcome everyone to today's episode of the FML podcast. Today we're joined by Ian Henderson, CEO at Kyckr. Ian, thanks for joining us today.
Thank you, good to be here.
Good stuff. So you're a bit of a force of nature in the banking world, and I've gone through your LinkedIn, but I'm definitely not going to be able to give it anywhere near as much justice as you'll be able to. For everyone listening today, could you just share a bit about yourself and your journey so far and your journey to Kyckr?
Of course, yes. So by way of, academic background starting there, degrees in economics, both in the UK and in Canada, that eventually led me to the world of banking. So for the first 23 years, I was working with two of the bigger UK banks with an international presence, RBS and Barclays. After 20 odd years in those businesses, I decided that with the growth of the challenger bank segment, I'd want to work for smaller, more nimbler organisations, and then I spent 8 years in the challenger banking world with Shawbrook initially, then Kensington, then latterly Arbuthnot Latham. And I guess I had a wake-up call after 30 years in one sector, that I wanted to do something a little bit different, and that was what prompted the transition out of mainstream banking and into the world of software as a service and business information, which is what I do with Kyckr. But to keep my hand in banking, I'm also sitting on the board of Metro Bank, a small UK challenger bank. So that's my potted history of the last 34 years.
So you've done a few bits and bobs then?
Just a few.
Just a few. Before we sort of jump into the journey at Kyckr, there's probably a lot of knowledge there that our listeners would want to tap into from the challenger banking perspective. So if we kind of start off at, say, Shawbrook, I mean, just as a broad question, could you just tell us a little bit about your journey there and how you grew that brand?
Sure. So Shawbrook was one of the first of the challenger banks to be established immediately after the financial crisis. And essentially what happened then was that there was a bit of a wake-up call that there were too many big banks. Those big banks were too big to fail. And there was certainly a lot of regulatory and government impetus to increase choice in the banking sector. True in the UK, but true of most other international jurisdictions where you tend to find a small number of banks dominate for economy of scale and other reasons. The big advantage that the challenger banks had, I guess, were threefold. One was that they were typically private equity backed and therefore had a degree of flexibility and nimbleness about them. Two, they were essentially starting from scratch, so they were not, straddled with legacy systems, with long-established bureaucracies, with big bureaucratic beasts to manage. And then thirdly and finally, because they were not universal banks, they were able to pick off the business segments that were particularly attractive with attractive returns. So that combination of those three things was what underpinned Shawbrook, but also underpinned the other challenger banks that existed at that time. And what Shawbrook chose to focus on was business banking and small business banking. It chose not to provide current account services because they are super expensive to establish and difficult to manage. So essentially it was a core lending proposition. So they raised funding via retail deposits through a very slick deposit raising engine, and essentially lent those to business customers at pretty decent margins. And that is a tried and tested model. And I guess I was with Shawbrook from the transition from loss-making early stage to its first year of profitability. I guess it was done on those three things: private equity backed flexible financing. It was picking off segments that were super profitable to go for, and was not hampered by legacy systems, and was able to pick off with a very high touch, high service proposition, fast turnaround times, and a very, very high standard of customer service.
In your intro, I mean, Shawbrook obviously wasn't your only time at a challenger organisation. I'm sort of keen to also ask a bit about the journey and find a little bit more about your time at Kensington and Arbuthnot as well, actually.
Kensington was, I guess, an opposite transition. Again, it was private equity backed, but taken out of Investec. The original plan there was to create a full service challenger bank, building on the premise of specialist mortgages. For various reasons, a decision was ultimately taken just to remain as a mortgage orientated institution. And for me, that's not really what I wanted to do. I wanted to do broader financial services, and that's what led to the move to Arbuthnot Latham, which had historically been a private bank. And I guess my task there was to broaden that Arbuthnot Latham proposition beyond private banking into commercial banking, into becoming a broader based challenger bank. It too was not private equity backed. It was a listed business on the secondary UK market, the AIM market.
There's obviously a flurry of neobanks and challenger banks that have sprung up over the last few years, not just in the UK, but in Europe and pretty much every territory, really, to be honest. And it seems like an incredibly competitive space. And we only have to have a look at Monzo and Starling and Revolut to see that it hasn't been the easiest ride. What advice would you give to anyone who's currently running a challenger bank or looking to establish a challenger bank? And what would you signpost for them? And what tactics would you take in today's market?
Yeah, so obviously the first challenge that a challenger has is making sure it's got access to funding and a capital base. So you need to establish a bank, whether it be a neobank or a broader based bank, you need to have access to capital, whether that's private equity capital, whether it's friends and family capital, whether it's angel capital, but you need access to capital. And then after that, you need to build the funding capability, which is around, to be blunt, raising retail and business deposits to then on lend. So if you get those two ticks in the box, that gives you a fantastic starting point. Your next challenge then is to figure out what are the target markets, but most important, given that target market, what's unique about you? What is going to be your point of differentiation? Because as you've said, there's lots out there, there's lots of competition. They're not all going to succeed because there's only so much market to go after. The one good thing is that the big banks will continue to offer relatively poor service. So there'll still be scope to go after aspects of their market, and therefore the basis of success has got to be built on your differentiated proposition, but most importantly, your service proposition. You live and die by your service proposition. You live and die by your ability to meet your turnaround times. And as I've touched on, big banks, pretty slow, pretty bureaucratic, pretty procedural through the different steps that you've got to. So if you can start to break those key points down and provide a fantastic service, then I think you're well on the way. But the easiest thing in the world to do is to lend money. Getting it back is the challenge, and therefore your credit and risk underwriting systems are critically important. So that's the other piece, sitting alongside your hopefully modern tech infrastructure without legacy to worry about, using modern, cloud-based systems and agile frameworks to build your capability. I think that mix is what you need to be successful in the challenger bank, neobank space.
It's interesting because a lot of the challenger banks don't have a lending functionality. I mean, Monzo's just released a similar sort of buy now, pay later type of proposition, but I don't think Revolut or Starling Bank offer anything at all like that. Do you think they're missing a trick?
Well, I think some do, and some are evolving in that direction. But to be blunt, the real margin is not to be made in current account banking. Although Monzo and Revolut do have currency and other angles from which they make income. It gets back to what was the basics of banking. Take deposits from one set of people and lend them to another set of people. Make sure you get those lending products paid back. So on that basis, that is the core of banking. And I think ultimately, to be successful, I think you can't really do it without a proper lending proposition.
In reality, we could probably just talk about the nuances of challenger banks, probably for the entire episode. But I want to switch streams a little bit, because your current role at Kyckr, it's not a challenger bank, it's something completely different. Do you want to introduce us to Kyckr and explain more about their proposition and what they do?
Yeah, of course, I'd be delighted to do so. So I joined Kyckr in early 2019, as I said earlier, after a 30-year career in the banking world. And one of my biggest pain points as a bank CEO was regulatory compliance. It was a huge challenge. And post-financial crash, post 9/11, the focus on anti-money laundering and trying to stop terrorist financing, I saw as a growth market, and that has proven to be the case. So what Kyckr does is it does the business equivalent if you're a private individual and wanted to open a new bank account, or engage with an accountant or legal practice, they'll not talk to you until you pitch up with your passport in one hand to show who you are and your utility bill in the other hand to show where you live. We do the business equivalent of that. We help organizations, KYB, know their business. And we do that by having built a network of connections to corporate registries globally. So in the UK, it's Companies House. In Australia, where we're listed, it's ASIC. But pretty much every country has its own corporate register. Some countries like the United States or Canada do it at a state or provincial level. And then what we are able to do is help our customers join the dots. So a business may begin in the UK, trading out of the UK, but it might be owned by a Luxembourg holding company. That Luxembourg holding company is actually owned by US private equity who choose to base that investment out of the Cayman Islands. So we help you follow the ownership chain and tree from that little trading business in the UK that you might want to provide payment services to or banking services to, right through to really understanding the ownership structure. The reality is that most companies begin and end in the same country, so begin and end in the UK or begin and end in Spain or begin and end in Australia. But lots of businesses have international angles, as the first example I gave indicate. So demonstrating to your regulatory overlords that you understand who your business is, who the shareholders are, who the directors are, the nature of the business, etc., are fundamentally important. And we help businesses do that. And I guess this came into sharp focus after the Russian invasion of Ukraine, where really understanding the sanctioned individuals out of Russia, the assets they owned internationally, etc., helping to understand those are the sorts of things that Kyckr can help financial services organisations better understand.
Kind of going back to the conversation around the challenger banks, and I suppose to a degree even legacy banks, do you see the future of KYC and compliance becoming more stringent? Do you think this is going to become more and more of a focus, or do you think we've kind of sort of peaked as to what the requirements are at the moment? Because, I mean, we've moved on a hell of a long way from in the last 10 years alone, really, or the last 5 years, to be fair.
Well, it's definitely not peaked. And the reason it's not peaked is the bad actors are pretty smart and they're good at staying one step ahead of the regulators and the financial organisations that they regulate. So I think that it will get progressively tougher as new mechanisms are found. They need to be closed off. So the regulators will continue to place heavy emphasis on this. The second reason I think it's only going to increase is that there's essentially zero scope for regulatory arbitrage. No country as a point of differentiation is going to make it easier to launder money or easier to finance terrorism, which means that high watermark will continue to get progressively higher. And then laterally, the fact that every year, every quarter, every month, some bank or payments company or financial services organisation is fined for regulatory failings in the world of anti-money laundering tells you that they're still not getting it right. They've got pretty good at onboarding customers, but the problem is once you've got a picture-perfect onboarding file, things change. The nature of the business changes, the directors change, the shareholders change. Perhaps bad actors get engaged in those businesses. You need to keep on top of that, and you'll hear increasingly talk of a thing called Perpetual Kyc, ongoing monitoring of your customers post-onboarding. And for all of those reasons, that's complicated to do. It's expensive to do because it's very manual. There's significant scope to automate this, and again, Kyckr's playing a role in that automation journey going forward.
That Perpetual KYC piece, I know that the big four, that are out there, the EYs, the PwCs, a large part of their business is going into these organisations, these larger banks, to help them, either improve their KYC compliance, financial crime processes, or actually sometimes to pick up the slack in perhaps some of the processes that have fallen apart. Do you think a platform like Kyckr will be able to eat perhaps some of PwC's and EY's lunches?
I should broaden it beyond the big four because there's a whole army of organisations out there that provide KYC platforms, KYC services, etc. What differentiates Kyckr from those is that we feed into all of those platforms. They need our data in order to do their jobs. So while we wouldn't fully eat their lunch, we can make their proposition stronger by giving them access to corporate information in 120 million businesses across over 100 countries through 300 regulatory approved sources. So in that sense, we help all those organisations. We don't compete with them head on. We're a key input to the processes that they create. Again,
talking about that sort of challenger banking environment, one of the points that you mentioned was about having slicker processes, and the way to sort of beat the traditional banks is to just basically be better. How does a platform like Kyckr help enable that? I can see on the B2C side, you've got platforms like Onfido that have really sort of made the process a lot more slicker. Does Kyckr offer the same thing for B2B?
Yes, no, it does. And I guess I touched on it earlier. And if I give the example of that initial one that I gave, where there's a little business that might be based in Essex, but it's actually owned by a Luxembourg business and ultimately by US private equity out of Cayman. You can have, other simpler businesses where they might be part of a multinational organisation whose ownership tree takes you into different parts of the world. So the single hottest topic right now in the world of AML and KYC compliance is a thing called ultimate beneficial owner discovery. So therefore, it really is who really owns this business. And again, it came into sharp focus with the Russian-Ukraine conflict, where you find super yachts sat in Antigua, and there's one actually being auctioned in Gibraltar at the current time, where actually who owned that asset. You'll probably find it's in a business structure. It'll be in a special purpose vehicle with all sorts of complexity built around it. So therefore, peeling back that onion to understand that is a critical angle there. So we can certainly help, and organizations like us can help actually pinpoint the work. So we can take a lot of work out of the journey by, in essentially a matter of seconds, peeling back the onion as far as you can from publicly available information, which means that the KYC analyst in the business can essentially, in 5 or 10 minutes with Kyckr tools, take away half a day of manual effort and then really only focus on the key thing they need to do. So let's say it was a trust structure that ultimately owned this business. We can say, go straight to the structure, ask your clients to show you who the beneficiaries of the trust structure are. And that's the only manual work you need to do because we've automated everything else away. So the good news for the modern challengers built on more modern technology platforms is that they can plug into that more readily than perhaps a more established traditional bank, where you've got various systems that have been built up over decades, and in some cases centuries, that you then need to plug into. And therefore, we can do this much more nimbly, much more quickly. And therefore, you've got a real key point of differentiation. It goes back to that onboarding journey. We can help a challenger bank onboard a client onto a modern tech platform much more quickly than a traditional bank could on its legacy platform.
Incredibly interesting. I just kind of want to switch streams ever so slightly and just sort of talk about the growth of Kyckr and kind of where you are in your current journey at the moment. I think you're listed at the moment and you're looking to take the company private. And also one of the reasons that you've come on board is to almost sort of affect a turnaround. Can you talk a little bit more about that?
Yeah, of course. So when I joined Kyckr, I think there was definitely a magic sauce to Kyckr, because what we have spent a number of years building is this network of registry connections so that you can follow ownership trees. That's a very, very difficult thing to build. And we know that lots of organizations have tried and actually said, this is too difficult. We'd rather, essentially buy it from the likes of Kyckr and their competitors rather than build it ourselves, because it's just difficult to do. So that's point number one. Point number two, as you've touched on, is we were originally privately owned, as many small new starts are. The business then listed in Australia because there was lots of advantages of so doing in terms of tech-orientated IPOs. And we did that before I joined the business back in 2016. The reality is that we did it prematurely. We did it just at the start of our significant growth journey. And a big part of the job that I was brought on to do was to start to deliver on those promises, which we've now done. We're generating pretty significant year-on-year, quarter-on-quarter performance improvements, to the extent that our largest current shareholder, one of Australia's richest people, has chosen to potentially buy all of the remaining shares in Kyckr. We're in the midst of that process at the moment, all of which is in the public domain. So probably sometime in October, there will be a shareholder vote. And if we hit the required thresholds, then that Australian tech billionaire will own Kyckr, and we will be back under private ownership. And I think that'll probably be a good outcome for Kyckr, because it will give us, access to capital, clearly, which we currently do have, but via the listed markets. And that comes with a whole host of challenges around reporting, obligations, and other things. So I guess the core bit of experience I've gained from this, having worked in listed and unlisted business previously, you need to be at a sufficient stage of maturity and financial delivery to be in the listed markets. We were not at that stage, and therefore the move to private ownership, I think, will be a significant benefit to the business. But ultimately, the big advantage that Kyckr has is that everyone needs our services, whether they recognise that or not. They need the business information we can give them access to. So if you're a small institution and all of your customer base resides in your home market, you could probably just build the links yourselves. But as soon as you've got, an international dimension to that which you do, then you really need something like that which Kyckr offers. And the marketing takes care of itself. We are inundated with inquiries from organisations that recognise in the business-to-business space, they need the tools and services companies like Kyckr offer.
You mentioned that you've been seeing sort of regular quarter-on-quarter growth. What do you think has been the catalyst behind that that's made Kyckr successful?
There's a few things. I think that getting our product service proposition right and our go-to-market right, that was a big bit of what we did initially. Getting the tech platform onto the cloud and the adoption of agile tech delivery methodologies all contributed. Strengthening the team, starting to increase the focus on Europe where there was a stronger regulatory bias was incredibly helpful. And I guess it was just that mix of activities that helped, deliver the growth that we've seen. And I guess underpinning all of that is gradual wakening up by financial services organisations of their obligations. They've all pretty much, they've touched on, ticked the onboarding box. So, very few of the penalties that you will now see meted out by regulators to banks and payments companies is for onboarding failures. It's for failing to keep up with the changes inside your customer base. And that's why Perpetual KYC is the hot topic, and understanding ultimate beneficial owners, both of which we've got, strong, service propositions to help customers deliver that obligation to their regulators.
What does the future hold for Kyckr? Assuming that your company gets taken private, what do the next sort of 3 to 5 years look like?
Yeah, I think the picture is really rosy because we've touched on it. We're operating in a market which is, on the one hand, crowded because there's lots of people playing the KYC game, the KYB game, but actually relatively few do what we do, which is the provision of legally authoritative registry-sourced data. The network that we've spent a number of years building is going to be very difficult to replicate, so there's high barriers to entry. So it's now all about leveraging all the things that I touched on. Strengthen team, strengthen tech, strengthen platforms, stronger products. But the next stage for me is moving beyond regulatory financial services, because again, a lot of our data can be used for non-KYC purposes. If you're a business and you've been approached by a business overseas, you don't know if it's a bona fide business, you don't know if it's a potential fraudster trying to inveigle its way into your business. So we can do very simple checks, what we call entity validation checks. Does this business in Argentina that's approached me about a contract exist, yes or no? Well, we can answer that question very quickly in a couple of seconds for you. So that opens up a whole new spectrum, whether that be, supply chain management, international logistics. There's a whole KYS, know your supplier piece. Then it can tie into, things like compliance with modern slavery, human trafficking. So there's a whole range of areas outside the narrow scope where we started, which was KYC, KYB. So again, we're super excited about where our data can help take us and our customers, both existing and potentially new and brand new to market opportunities for the business. One
final question before we move on to our quick fire round. Throughout our entire conversation, the one thing I picked up on is especially sort of in the latter part of your career, you're somewhat of a turnaround artist. You're coming into businesses, making big changes and putting them onto the right track. I suppose my question is, why are you so good at that? What is the angle that you take? How have you developed that skill? What is it that you do? What's your magic sauce that makes that so effective?
Gosh, you're making me look in the mirror, and it's one thing that I guess I've not fully thought through. So maybe it starts off with my original roots of studying the dismal science of economics, where it all comes down to facts and analysis. Build up your fact base, make all decisions based on facts. It would be point number one. Point number two, pretty much every business is only as good as its people. So make sure you've got the right people in and around you. If you inherit the wrong people, then the blunt answer is you've got to move them on and move them on quickly and get the right people. And so there's that people angle to it. There's the whole product market fit, because some businesses that are in need of a turnaround might never be turned around because either the market's moved against them, the product doesn't fit. So that's a quite important angle to get on top of relatively quickly. And I guess ultimately it comes back to the dismal science of economics, and it's about efficiency and effectiveness and making sure that what you do is efficient and is as effective as possible. So these are the sorts of levers that I typically pull in organisations that I work in, and generally it's kind of worked for me and the businesses I've worked in. They've all tended to establish a pretty strong growth trajectory on the back of those various, A, the diagnosis, and then B, the pills that you offer up to fix that.
That's fantastic. No, I really appreciate that. Thank you. Moving on to our quick fire round, we'll move away from the seriousness of KYC and compliance and maybe the hard-hitting questions. What podcasts do you have on repeat at the moment?
Gosh, there's lots that I listen to. So I'm interested in politics, so I listen to quite a few political podcasts. I'm interested in the arts, so there's quite a lot of music podcasts that I listen to. In terms of business to business, there's not too many, to be honest, that I'm listening to right now on a regular basis. And maybe it's because I'm time starved, and I maybe ask you the same question. What ones do you think I should be listening to?
In the B2B space, well, there's obviously ours. I quite listening to My First Million, which I find is with Sam Parr and there's another gent. And I think it's always really, really interesting because they're always uncovering new business models and different types of businesses. And you realise that there's a whole world outside of apps and tech. And actually, there are a lot of businesses that do make really good, serious money. And I think there's lots of learnings that you can take from that as well. So that's one of my favourites. What books are you currently reading at the moment, or which books would you recommend?
The one that I'm currently reading is called The Great Circle. It's a novel about a female pilot who sort of circumnavigated the world. So that's the one I've just kicked off on that one. Latterly, I've been actually catching up on some books from the past, the sort of Smiley series and John le Carrier books. In terms of business books, it tends to be more economics that I read. It goes back to my natural economic background, and I know that in some respects it's deemed to be yesterday's news, but I do periodically revisit GE and the work that was done there, because I think there's some amazing business concepts that were developed by Jack Welch, and I think they're certainly worthy of revisiting, even in a sort of modern tech environment. It comes back to my efficiency and effectiveness point. That was a big touchstone for him. And I do go back and revisit some of the tools that he applied in more traditional businesses and the extent to which they can be applied in modern tech-orientated businesses. Other
than Kyckr, what's your favourite fintech business? Which one do you always keep your eye on?
You've touched on a couple of them already. Monzo and Revolut, I follow them with interest, but they're pretty substantial businesses now with global operations. Because of my early roots in business-to-business challenger banking, then you've touched on one, Starling, but Tide, I think, is quite a neat app-based fintech business. In the sort of RegTech world that I currently inhabit, then I think that there's probably too much of a proliferation there, and I think there'll probably be some culling. That capital markets are tightening now, and there's been some reports that fintech capital raises and RegTech capital raises have reduced quite significantly over the last period. So again, the difference between winners and losers is going to be an interesting journey, and I think we'll start to see some significant consolidation happening, and I think there's a few firms there that might lead that consolidation journey.
What's the best bit of life advice you've ever received?
One of my previous bosses had this little saying, which was plagiarize, let no one else's great ideas evade your eyes. For me, it's the ability to pick individual great components and then bolt them together in a way that's kind of got your fingerprints on it. And therefore, there is no monopoly on great ideas. And I think there's lots of great ideas that can be made better, can be bolted together, can be integrated. So for me, that's something I've tried to always do. And that is, you don't need to do everything from first principles. You can do it from second and third principles by picking up on stuff that's gone before you. I touched on it with Jack Welch. I think he did some amazing stuff back in the day, albeit it might be, some of it might be frowned upon now, but I think there's still components there that can be built upon. I guess even today's fintechs, regtechs, neobanks, etc. Well, guess what? It goes back to the very simple premise of banking. Take one person's deposits and then lend them to somebody else who has a need and make the margin in the middle. And so long as you get the lending monies back, then you've got a pretty sound and robust business model. I think the reason many banks have failed is that they've actually forgotten those basic principles of taking deposits and then lending it sensibly and carefully. Most of those who have failed is because they started to go beyond the world of banking or got ideas beyond their station.
There's a lot of organisations out there that call themselves a bank when in reality they're more for a wallet or a payment solution. And I don't think there's anything wrong with that. I think, lean into what you are and try and make money with it rather than try to be something else. But I mean, that's a different story for a different day. And then my favourite question, what's one thing that I haven't asked that you perhaps felt I should have?
You've asked a pretty comprehensive set of questions. Maybe the one thing that you could have asked is that were I to be in possession of a crystal ball, what does the future look like? So I guess we've touched on a little bit about it. You posed the question about, will regulatory compliance around KYC, KYB, is it plateauing? And I addressed that by saying, no, it's always going to increase. But there's other angles out there of what the future business holds. And, we're potentially moving into, a global economic slowdown. What does that mean for different businesses? But as I say, not possessed with a crystal ball will make that one difficult to answer.
Do you want to have a go at it?
So the economic slowdown clearly will affect different businesses in different ways. I think for the world in which Kyckr inhabits, then we might see we'll definitely see a slowdown in onboarding because new businesses will be slower to form. There might be some consolidations that will take place. This will give organisations the opportunity to catch up on this perpetual KYC point, to actually pause, look at their customer bases, start to grapple the issue that they've either been an ostrich about, putting their head in the sand and saying, this is actually quite difficult, quite challenging. We've got huge captive customer bases. We don't really want to touch that until we really, really have to. I think that the reality is that they'll be forced to do that. And maybe if they're getting a little bit quieter, then use their existing resources to grapple that question because it's a significant forthcoming challenge that they're going to face.
Brilliant. Thank you. Ian, thank you very much for your time today, and thank you very much for coming onto the podcast.
It was a pleasure. Thank you for your time.
The FML podcast is brought to you by Growth Gorilla. To find out how our marketing growth experts can boost your fintech's growth, head to growthgorilla.co.uk. And make sure to search for the FML podcast in Apple Podcasts, Spotify, or anywhere else podcasts are found. Don't forget to click follow to ensure you don't miss any future episodes. On behalf of the team here at Growth Gorilla, thanks for listening.